SIP in rising or falling market. Systematic investment plans in mutual funds or SIP in rising markets or falling markets. Which one you should prefer? Most retail investors prefer to continue their SIPs in equity mutual funds when the market keeps on rising, and they prefer to stop their SIPs when the market starts falling. Is this the right way to invest? Let's discuss this with an illustrative example that will help you to understand the right way of investing. SIP in rising markets. An investor started his SIP for rupees 10,000 per month. For the next 12 months, the market started rising. Markets almost double. So he continued his SIPs. During the bullish phase, when the markets almost double, the SIPs look something like this. As you can see that the 10,000 investments where the NAV was 10 rupees, and the in the first month the units were allocated over 1,000 units, and at the end of 12th month he continued the investments of 10,000 rupees at the NAV of 21. The units were 476. So the balance total units in these 12 months was 800 and 1,064 units, and with the investment of 1,20,000, the current value is 1,71,442 rupees. In a rising market where the investor never saw the portfolio negative, he continues his SIP of rupees 10,000 per month, and with the investment of 1,20,000 at the end of the year, where the markets almost double, his investments also grow to 1,71,442 rupees. Like in these scenario where you have never seen the markets in negative, you have never seen your portfolio negative, despite you are investing into equity mutual funds, and within a 1 year span, you have seen that the investments have grown at a very decent rate. Now we will understand that what happens when the market starts falling once you start the SIPs. SIP in falling markets. Now, similarly, an investor started SIP of rupees 10,000 per month, and he continued his SIP. What happened was, for the first few months, the markets almost become half, 50% fall in the markets, and then next the markets recover to its previous level. So, if you started SIP of rupees 10,000 per month in the first month where the NAV was 10 rupees, the unit allotted was 1,000. And as you can see in this illustrative example, that with a continued investment where the NAVs was firstly falling for the first 6 months, it's from 9, 8, 7, 6, 5. The units were at 2,000, almost double units, because the markets were at half or 50% discount on the previous rate. Now, over the period in the next 5 6 months, the markets recovered to its previous level, and the NAV were 11. So, in this total 12 months period, these the same amount, the same investments, where the markets were started falling from the first investment, the total units were 15,822. So, with the investment of 1,20,000, here the value comes to 1,74,000 and 40 rupees, where the market just recovered to its previous level by correcting more than 50%. So this is how the markets work when you continue your SIPs in the falling markets. If you have continued SIPs in the falling market, you have generated more returns as comparatively you are continuing your SIPs in the rising market. So over the period, when you as you, in through this illustrative example, we can see that there is a huge difference, that once there is an investor who has never seen his portfolio negative, but over the period he is reaching almost at the same destination, whereas an investor who has never seen the portfolio positive, the markets were almost decreasing, but he continued his investment, he was disciplined. So markets when recovered, they have generated a decent returns, in fact more than the returns that was generated by the person who was investing in the rising market. So this is how SIPs work. This is how systematic investment plan, with the power of discipline and the power of equity, the right approach, the cost of averaging of the rupee cost averaging benefit gives you the extra benefit. So you should in fact increase your SIPs when the market falls. You should not stop your SIP. This should not be your ultimate goal, because if you'll get panic when the market starts falling and stop our SIPs in equity mutual funds, we won't garner the best results. If we will increase almost double our SIP amount during the market fall, then we will also garner the best results with this discipline and the power of compounding, even if the market recovers. So we don't need a growth. We need the best strategy to cater the best investment, best returns on our portfolios. That's the right way to invest. Choose your investment style and increase your SIPs when markets fall instead of decreasing or stopping. That's all for today. Thank you.